$1 trillion. Gone. Just poof. Evaporated into the ether in less than 48 hours. If you blinked, you missed it. If you slept, you woke up poorer. We are not talking about a correction. We aren't talking about a healthy pullback. We are talking about a slaughter, a calculated, mechanical dismantling of the single most aggressive bull narrative of the decade. And the worst part, the absolute worst part, isn't the red candles on the chart. It's why it happened. Because they lied to you. For 6 months, 6 agonizing months, every talking head on CNBC, every expert on Twitter with a laser eye profile picture, every suit at the Federal Reserve told you the same story. They sang the same lullaby. Just wait for the pivot. Just wait for the rate cut. Once Powell cuts rates, the liquidity spigot opens. The money printer goes burr, and risk assets go to the moon. That was the promise, right? That was the deal. You hold through the pain and the Fed saves you. Well, on December 10th, you got exactly what you asked for. The Fed cut rates. 25 basis points. The pivot finally happened. And what did the market do? Did it moon? Did Bitcoin scream to $100,000? No, it plummeted. It cratered from $94,000 straight down to $88,000 in a violent vertical line that wiped out over $400 million in leveraged long positions before you could even open your Coinbase app. Think about that. The good news was the trigger for the crash. That should terrify you. This is a classic sell the news event, but on steroids. It exposes a fragility in this market that nobody wants to talk about because it ruins the sales pitch for the ETFs. See, the narrative was that institutional money, BlackRock, Fidelity, would create a floor. They told you there was a safety net. But when the whales saw that Fed announcement, they didn't buy. They used you as exit liquidity. We have on-chain data, I'm looking at it right now, showing a single entity dumping $100 million worth of Bitcoin in a 60-minute window immediately following the announcement. While you were reading the headlines thinking, great, rates are down, time to buy, they were selling into your buy orders. They were handing you their heavy bags and walking out the back door. And if you're sitting there thinking, well, I don't own crypto, this doesn't affect me, wake up. You are missing the signal. Bitcoin is the canary in the coal mine. It is the purest liquidity gauge we have. If the most sensitive risk asset in the world is vomiting value after the Fed eases policy, it means the market doesn't believe the Fed can save the economy. It means the soft landing is a fairy tale. It means the market is smelling stagflation, sticky inflation, and a dying economy, and it is running for the hills. This wasn't a glitch. This was a warning shot aimed directly at your 401k, your tech stocks, and your real estate values. The smart money just showed their hand. They are cashing out, and you're still holding the bag. But I'm going to show you exactly how they rigged this drop, and why the death line they just crossed might mean the party is officially over. Stay with me. You have to understand the conditioning. For 15 years, literally since the ashes of 2008, you have been trained like a dog in a Pavlovian experiment. Bell rings, dog gets food. Fed cuts rates, stocks go up. It's been the only rule that matters. We saw it in 2019 when Powell tried to tighten and the market threw a tantrum until he pivoted. We saw it in March 2020, the holy grail of money printing, where the world shut down but your portfolio doubled because they flooded the system with $4 trillion in fresh liquidity. That broke everyone's brain. It convinced an entire generation of investors, Gen Z, millennials, even the boomers, that the economy and the stock market are the same thing. They aren't. They never were, but the illusion held because money was free. You could borrow at 0%. Companies with no profit could run on debt forever. Bitcoin could fly because, hey, the dollar is trash. Might as well buy the digital gold, right? But let's go deeper. You need to look at the architecture of this trap. Go back to late 2024. The inflation numbers started getting sticky, not transitory sticky, I mean concrete sticky. We were hovering above 3%, refusing to come down. Powell knew it, Yellen knew it, but they had a problem. The U.S. government interest payments were exploding. They were paying over $1 trillion a year just on the interest of the national debt. They had to cut rates, not to save you, not to save the stock market, but to save the Treasury from defaulting on its own bonds. So they started the whisper campaign. The soft landing, remember that phrase? It's going to be on the tombstone of the middle class. They spent all of 2025 telling you that the economy was cooling, just enough to kill inflation, but not enough to cause a recession. It was the Goldilocks narrative, and the market bought it. Hook, line, and sinker. That's why Bitcoin ran to 94,000. That's why the S&P hit fresh highs. The market was front-running the celebration. They were buying the rumor that the Fed had pulled off the impossible. But here is the ugly truth they left out of the press release. When the Fed cuts rates when the economy is strong, that's rocket fuel. That's 1995. But when the Fed cuts rates because the economy is cracking, that's 2000. That's 2008. That is a panic signal. And on December 10th, when they finally cut that 25 basis points, the smart money didn't hear a dinner bell. They heard a fire alarm. Because look at the data released the same week. It wasn't just the rate cut. It was the jobs revision. It was the manufacturing PMI dipping into contraction for the fifth month in a row. The soft landing narrative died the moment the rate cut was announced, because the cut itself was an admission that the economy is gasping for air. Now, I know what you're thinking. I can hear you screaming at the screen, but lower rates mean cheaper loans. It means liquidity. That has to be bullish for crypto. Stop. That is the trap. That is the thinking that got you liquidated yesterday. Liquidity is only bullish if people want to take risks. If I give you a credit card with a low interest rate, but you just lost your job and your house is on fire, are you going to go buy a new TV? No, you're going to hoard cash. You're going to pay off debt. You are going to de-risk. That is exactly what is happening on a macro scale. The whales aren't looking at the cheaper cost of borrowing. They are looking at a consumer who is tapped out. They are looking at credit card delinquencies hitting highs we haven't seen since the great financial crisis. They realized that this rate cut wasn't a stimulus check, it was a bandage on a gunshot wound. And this is where the villain comes in. The villain isn't just Powell. It's the institutional machine, the BlackRocks, the Fidelities, who control the ETF flows. Look at the numbers from December 11th. We didn't just see price drop, we saw outflows. Over $220 million pulled out of the spot Bitcoin ETFs in a single day. These are the guys who were supposed to be the diamond hands, right? The institutional adoption that would send us to $1 million? They folded. The second the narrative shifted from inflation hedge to recession risk, they hit the sell button faster than a retail trader checking his balance. They treated Bitcoin exactly like a tech stock. They treated it like a high beta NASDAQ play. And because the liquidity in the crypto markets is so thin compared to the stock market, when they rushed for the exit, the door wasn't wide enough. That's why you saw that wicked wick down to 88,000. That wasn't organic selling, that was a liquidity cascade. One whale sells, pushing the price down. That triggers a margin call for the degenerates leveraged 50x long. Their positions get forced sold, which pushes the price down further, triggering the next guy and the next guy. It's a domino effect of pain. And the media? They are still gaslighting you. They're calling it profit-taking. Profit-taking? You don't dump $1 trillion in market cap immediately after the event you've been waiting 2 years for. That's fleeing the scene of a crime. So here we are. The Fed has fired its silver bullet. They cut rates. And the monster didn't die. In fact, the monster just got angrier. The market has realized that the Fed is out of ammo. If they cut more, inflation roars back because supply chains are broken. If they don't cut, the debt suffocates the economy. They are trapped. But there is one card they haven't played yet, one desperate, dangerous card that the crypto bulls are praying for, the money printer. Quantitative easing. The idea is that if things get bad enough, they'll just print their way out of it again, like 2020. And if they print, Bitcoin goes to the moon, right? That's the hope. That's the lifeline you're holding on to. Let me explain why that hope is the most dangerous thing in your portfolio right now. You're sitting at a poker table. That's the economy. For the last 15 years, the Fed has been the guy standing behind you, slipping you chips every time you lose a hand. You play a bad hand, here's $1,000. You go all in on a pair of twos and lose, here's another $1,000,000. That was quantitative easing. That was the Fed put. The game was rigged so you literally couldn't go bust. It didn't matter if you were reckless. It didn't matter if you bought JPEGs of monkeys or companies that make electric trucks that don't actually drive. The chips kept coming. But now, imagine the casino boss walks over. That's inflation, and he whispers in the Fed's ear, "Hey, every time you give this guy a chip, I'm gonna burn down a grocery store." Suddenly, the guy slipping you chips stops. He freezes. He looks at you, sweating. You're looking at him, waiting for your refill because you just bet the house on a pivot. But he can't give it to you. If he hands you one more chip, the price of bread goes to $20 and the streets catch fire. But if he doesn't give you the chip, you bust out and the game ends. That is the mechanism of the trap. We aren't in 2020 anymore. In 2020, inflation was dead. They could print $5 trillion and get away with it. Today, inflation is a sleeping dragon in the corner of the room. You poke it with stimulus, you poke it with QE, and it wakes up and eats the middle class alive. Think of it like a guy, let's call him Uncle Sam, who has 10 maxed out credit cards. For years, he's been paying off Visa with MasterCard and MasterCard with Amex. He's shifting the debt around, paying the minimums. It works as long as the banks keep raising his credit limit. But December 10th was the day the bank manager called and said, "No more." Uncle Sam is sitting there with $35 trillion in debt. The interest rate on that debt just jumped. He needs to borrow more just to pay the interest on what he already owes. It's a death spiral, a literal mathematical impossibility, and the only way out is to print money to pay the debt. But here is the kicker, and this is the part that Wall Street prays you don't understand. When you print money to pay debt in an inflationary environment, you don't solve the debt, you destroy the currency. The market knows this. That whale who dumped $100 million in Bitcoin, he wasn't selling because he hates crypto. He was selling because he realized the dollar is trapped between hyperinflation and default. He moved to cash not because cash is good, but because cash is the only thing that buys you time to figure out where to run next. They are stuck. If they turn left, if they lower rates aggressively and turn the printer back on, inflation explodes to double digits. Your grocery bill doubles. Gas hits $7. The voters revolt. If they turn right, if they keep rates high to fight inflation, the interest payments on the national debt swallow the entire federal budget, and the banking system collapses under the weight of bad commercial real estate loans. I know, it sounds crazy. I wish I was making this up. I wish I could tell you this is just some doom and gloom YouTube theory. But look at the Treasury market. Look at the 10-year yield. It should be going down if the Fed is cutting rates, right? That's Econ 101. But it's not. It's staying stubbornly high. Why? Because the people who lend money to America, the bond market, are demanding a premium because they know the U.S. government is broke. They are pricing in the risk that the only way they get paid back is with funny money. This is the domino effect, and it doesn't start with Bitcoin. It starts with the bonds. When the bond yields refuse to drop, mortgage rates stay high. When mortgage rates stay high, nobody buys houses. When nobody buys houses, home prices eventually crack. When home prices crack, the banks holding those mortgages as collateral are suddenly insolvent. It's 2008 all over again, but this time the government can't bail them out because the government is the one who caused the problem. We are watching a slow-motion car accident where the driver, the Fed, is arguing with the passenger, the Treasury, about who should grab the wheel while the car is already off the cliff. The crypto market just looked out the window, saw the ground rushing up, and screamed. That's what that trillion-dollar wipeout was. It was the realization that there is no airbag. The point of no return wasn't the rate cut, it was the market's reaction to it. The market rejected the medicine. The patient is sick, the doctor gave the shot, and the patient went into cardiac arrest. That tells you the disease is terminal. The structural leverage in the system, the billions borrowed to buy Bitcoin, to buy Nvidia, to buy real estate, needs constant accelerating liquidity just to stay level. When that liquidity paused, gravity took over. So now we are staring down the barrel of a liquidity vacuum. The whales have cashed out, the retail traders are trapped in underwater positions, and the Fed is standing there with a pair of scissors wondering why cutting the rate ribbon didn't start the party. They don't realize the building is already on fire, and the exits, they're getting smaller by the minute. Now, let's talk about where this goes, because if you think this is just a dip, you are going to get slaughtered. We need to talk about 2026. We need to talk about what happens when the dust settles and the dollar isn't the king anymore. So, what happens next? This is the part where the rubber meets the road. This is where we stop analyzing the car crash and start figuring out how to survive the pileup. Because, make no mistake, we are at a fork in the road, and there are only two ways this plays out. Scenario 1. The Weimar option. The Fed looks at this crash, they look at the fragility of the banking system, and they panic. They call an emergency meeting on a Sunday night, just like they did with Silicon Valley Bank, and they announce unlimited support. They turn the printers on full blast. They buy bonds, they buy stocks, they maybe even buy Bitcoin ETF shares to stabilize the market. If that happens, your portfolio goes vertical. Bitcoin hits 200,000, the Dow hits 50,000. You feel like a genius, but a loaf of bread costs $25. Your salary stays the same, but your rent doubles. You become a paper millionaire living in poverty. That is hyperinflation. That is the death of the currency. It's a sugar high followed by a diabetic coma. But I don't think that's what happens first. I think we are looking at scenario 2, the Great Flush. The powers that be, the ones who actually run this show, know that inflation is the one thing that causes revolutions. Hungry people don't vote, they burn down parliaments. So they might let this crash burn. They might step back and let the market liquidate. They will let Bitcoin fall to 50,000. They will let the S&P drop 30%. They will let the unemployment rate tick up to 6, maybe 7%. Why? Because they need to break the psychology of inflation. They need you to feel so scared to spend money that prices finally come down. They need to destroy demand. And the only way to do that is to make you feel poor. This crypto bloodbath we just watched, that was part of the plan. It wiped out $1 trillion of wealth effect. That's $1 trillion that isn't chasing goods and services anymore. And once the dust settles, once the weak hands are washed out, once the zombie companies are bankrupt, and once the middle class is begging for help, then and only then will they bring in the solution. And this is the 2030 vision you need to be ready for. By 2030, this crash will be a footnote in a history book, but the result of this crash will be your daily reality. They will use this volatility as the excuse to introduce central bank digital currencies, CBDCs. Mark my words. They will say, look at Bitcoin. It crashed 50% in a week. It's unsafe. It's for criminals. But here is FedCoin. It's stable. It's safe. And we can deposit it directly into your phone to stimulate the economy. But there's a catch. FedCoin isn't money. It's a control grid. It's programmable. If they want to stimulate the auto industry, they can give you credits that expire if you don't buy a car in 30 days. If they don't like your political posts, they can turn off your ability to travel. That is the end game. The destruction of the current financial system is a controlled demolition to clear the lot for the new system, a system where you own nothing and you are happy because the state provides your allowance. So, knowing this, knowing the game is rigged, knowing the house always wins, what do you actually do? Do you curl up in a ball? Do you sell everything and move to a cabin in the woods? No, you get smart, you get sovereign. First, stop playing their game. Stop trading on 50x leverage. Stop trying to get rich quick on meme coins named after frogs. That is a casino designed to take your money. If you are in crypto, you need to understand why you are in it. Are you in it to make more fiat dollars, or are you in it to opt out of the fiat system? If you are in it for the revolution, then the price in dollars doesn't matter. One Bitcoin is one Bitcoin. But, and this is non-negotiable, if your coins are on an exchange, you don't own them. We just saw whales liquidate billions. Do you think Coinbase or Binance will prioritize your withdrawal when the run on the bank starts? Absolutely not. Get a hardware wallet, get your assets offline. If you don't hold the keys, you are just an unsecured creditor to a tech company that can freeze your account with a single email. Second, build a position in reality. Digital assets are great, but you can't eat Bitcoin. You can't live inside a stock certificate. You need tangible value. That means gold, that means silver, that means land if you can afford it. It means skills. In a recession, the most valuable asset isn't a stock portfolio, it's the ability to fix a car, grow food, or repair a roof. Those are inflation-proof skills. Third, get liquid. Cash is trash in the long run, but in a crash, cash is king. Cash buys you options when everyone else is forced to sell their assets for pennies on the dollar because they have margin calls. You want to be the one standing there with dry powder, ready to buy quality assets at a discount. Don't be fully invested. Keep a war chest. And finally, turn off the noise. The news cycle is designed to keep you in a state of high cortisol panic. They want you emotional. They want you reacting. The most rebellious thing you can do is to be calm, to zoom out, to realize that this has happened before, in 1929, in 1971, in 2008, and humanity survived. You are not powerless. You are just waking up. The fact that you are listening to this, the fact that you are asking these questions, puts you in the top 1% of the population. Most people are sleepwalking off the cliff. You are looking at the map. The system is breaking. That's scary, but it's also an opportunity. The old guard is dying. The new world is being born. It's going to be volatile. It's going to be messy, but for those who are prepared, for those who are sovereign, it's going to be the greatest transfer of wealth in history. Stay sharp, stay sovereign, and don't let them shake you out. I'll see you on the other side.